balances do not get carried forward. But permanent accounts, such as assets, liabilities, and stockholders' equity accounts, do get carried forward. The ending balance of one period is the beginning balance of the next period. Then we have something called a contra account. The contra accounts are basically a way in which we keep track of, such as accumulated depreciation that we've always taken on certain assets. These contra accounts basically help us really know what the adjusted basis is in an asset. So if we buy a truck for $20,000 and we bought it back in 2012, and in 2012 we took $4,000 on it, our accumulated depreciation at the end of 2012 would be 4. Okay? At the end of 2013, it's going to be 8. At the end of 2014, it may be 12,000. We're still going to show on our books that truck's cost is 20. We know that shows what our price is we paid for it. The accumulated depreciation shows what we've expensed throughout the period of owning that truck. And the difference between the cost of the truck minus the accumulated depreciation is the adjusted basis of the asset. Make sense? So here is an example of our permanent accounts and our temporary accounts. Our permanent accounts include our assets. We know that an asset has a normal debit balance, which means when we increase an asset, we debit it. When we decrease an asset, we credit it. Hopefully, we don't have a minus asset. We still need to have some form of that asset, which will be a normal debit balance. Our liabilities are the opposite of that. When we increase a liability, we credit it. When we decrease a liability, we debit it. So our normal balance of a liability account is a normal credit balance. And then with shareholders' equity, common stock, when we increase our common stock or our capital, we credit it. When we buy back shares, we generally have a separate account called treasury shares, but we basically will debit that account. We're reducing it. We'll still have a normal credit balance. Retained earnings is the same. Retained earnings, when we have net income, we're going to credit it to retained earnings to increase it. When we pay out dividends, that's going to be a decrease ultimately to our retained earnings. And then our AOCI accounts also. The normal balance will be a credit, and when we reduce that AOCI account, it's going to be a debit. Now our temporary accounts, our revenues and our expenses, revenues also have a normal credit balance. I like to think of it as when I provide a service, I'm either going to receive cash or accounts receivable. Cash or accounts receivable is an asset. When the asset goes up, I'm debiting that asset, so I've got to credit a revenue. Make sense? Likewise, with expenses, when we pay an expense, we're going to debit that expense. Again, I always do everything as it relates to cash. When I pay a bill, I'm going to reduce my cash, which means credit it. Therefore, I have to debit my expense. Does that help, guys? Or I always think everything in the form of cash. Yes?
One thing I'm a little confused on that review. You said when you buy back common stock that decreases?
Our shareholders' equity.
Okay,
Because we have
somebody
all...
owns it and not the shareholders.
Correct.
Okay.
We're trying to bring in, we don't want so much outstanding stock. So we're bringing it back in. We need to use our resources to bring in some outstanding shares. So we're reducing those outstanding shares the public has. Okay. Now, every company, public company, issues an annual report. This annual report provides all kinds of information. Did I show you last week the target? Okay, 2 weeks ago. So basically, it provides you with a host of information, but mainly in here, or not mainly, but importantly, the financial information is a part of this annual report. That's issued once a year. We'll have quarterly reports that are issued for each quarter at a time. And they are what we call interim statements, and they, if you're a public company, must be issued to the SEC every quarter. So one question here is, what are the names of the primary financial statements? Balance sheet, income statement, statement of cash flows, statement of retained earnings, or stockholders' equity section. I mean, depending on which class I'm teaching, sometimes it's retained earnings, but the stockholders' equity shows the breakdown of everything that's happened, all in the retained earnings also, and in the stock section. So we've got this wonderful accounting cycle we complete every year. What do? We analyze the transactions, events, and arrangements in a journal. We analyze them, and then we record them. We post all the journal entries to the ledgers. So we initially put them in a journal, general journal. Then we'll post those transactions to the various accounts. Then we prepare and post any adjusting entries we need to do. We prepare financial statements. Usually we start with the trial balance, and then from there we prepare financial statements. We may have some closing entries we're going to do to zero out all those temporary accounts we're talking about, the revenues and expenses. And we basically then end up creating a new trial balance that just has the permanent accounts in it. So here is how this works. We purchase inventory on credit. We received a bill from the vendor for $100. We're going to record in a journal a debit to inventory because it's an asset and it's increasing, and a credit to accounts payable because we owe them the money. So our asset is increasing and our liability is increasing. Then we post it to the various accounts. So we're going to take our inventory and post it, increase our inventory account 100. We're going to post our accounts payable, increase our accounts payable, that storehouse 100. And then ultimately we're going to put these in financial statements. We're in the balance sheet. We're going to show an inventory asset of 100, and we're going to have an accounts payable of 100. Now, ultimately, we have a lot of transactions we record to then come up with a financial statement. So it's a series of tons and tons of transactions over the accounting cycle that ultimately then prepare financial statements. When we record into a general journal entry, there's a real specific format that we should use. The first column is the date column. The second column lists the accounts and how much is affected by each entry. Now, the second column, we generally start with our debits first, and then we're going to enter our credits next. I'm just going to show you an account real quick. Let's see here if I have anything. I don't. Actually, let me get in the book. I'm sure there's something in the book to show. find page 3-15. So here's an example of journal entries. We start with a column for the date, and then we have our accounts. And we always start with the debits. We list all the debits to a particular transaction first, then our credits. The amounts we post the amounts to the debits, the amounts to the credits, which each transaction needs to always balance. And then we provide an explanation as to the reason for this transaction. Now, the one thing missing from this particular one is there can be another column in here where we write in the account number. That's not showing on here. Okay, so we basically have the date column, the account information, there should be a column that shows the account number, and then the amounts in the debit and credit columns are going to coincide with those accounts. Each transaction always gets recorded in the general journal, and we have to write an explanation below each transaction. So let's come up with an example here. Jamie Corporation incorporates on January 1st as a wholesaler. The company uses a perpetual inventory system, so it's probably a computerized system that always keeps track of where everything is, in which the inventory account is updated after each purchase. During 2013, Jamie engages in a series of transactions. The first transaction, various shareholders invest in Jamie by purchasing 2,000 shares of no-par stock at $10 a share. Okay, so that's the transaction. What happened? People gave Jamie money in exchange for stock certificates, right? So when we think about it, receiving that money increased the cash, which ultimately increased the assets, 20,000. And the common stock also, because it was issued, was increased 20,000. So we're going to show the date, a debit to cash. You see over here a debit of 20. And then we've got a credit to common stock, which is part of the shareholders' equity section. And the normal balance of shareholders' equity is a credit, contributed capital. So we show our debit, our credit, and we show an explanation. We issued 2,000 shares of no par stock at $10 a share. So here's what occurred. What would be our source documents here? The bank statements. And we probably, the stock vouchers that show the stock was issued. Now here's another one. Jamie purchases 2 acres of land as a building site, paying $1,500 an acre. What's happening here to land? It's going up. What's happening to cash? Do our assets change? No. But the form of our assets are changing, aren't they? So basically, the asset land is going to go up 3,000, and the asset cash is going to go down 3,000. So you see here the date. We show a debit to land because that's the debit. And then we show a credit to cash of 3,000. See, our debits always equal our credits here. And we purchased 2 acres of land at $1,500 per acre. Make sense? Now, here's another one. Jamie purchases a building and equipment for $15,320 and $2,120. So the building $15,320, the equipment $2,120. Jamie pays cash of $10,840, signs a 12%